Many market participants thought that the Fed would not raise interest rates. The increasing federal funds rate has put massive pressure on the financial system. Today, we're going to look through Jerome Powell's FOMC statement. What exactly did he say? What are the next steps and what does it mean for you? We're also going to look at the key charts. Hi everyone, I'm Ken from CryptoTradingKS, aiming to boost your financial and emotional success. With 30 plus years in financial markets, I share exclusive content for market success. Subscribe for game-changing insights. Let's run the numbers. I'm going to take you through the transcript of Chair Powell's press conference. The first thing that's stated, the banking system is improving. It's sound and resilient. The Federal Reserve was created in 1913 with the primary purpose to enhance the stability of the American banking system. There is a problem in the banking system. This Wikipedia article talks about the liquidation of Silvergate Bank, then Silicon Valley Bank, which was the 16th largest bank in the US, then Signature Bank, the collapse of First Republic Bank. We're also seeing tremors emerging in other banking corporations. When Washington Mutual Bank went down in the GFC, you can see just how many others were brought down with it. This is not a reason to freak out, it's a reason to get prepared. Life has unlimited problems, so we must not focus on the problems, we must focus on the solutions. When it comes to financial markets, when fear grabs a hold of your buying or selling decisions, it usually decimates your portfolio. That's why Rule 734 is so important. Master emotional control. In Jerome Powell's speech, he said, "We will work to prevent events like this happening again by addressing the rules and supervisory practices." History has shown time and time again that this may help indeed, but it's not going to solve banking crises. Many FOMC speeches are just carbon copies of each other. Jerome said about monetary policy, the Fed has two goals: to maximize employment and stabilize prices. It's seeking to bring inflation back to the target of 2%. Many market participants thought that the Fed would pivot. We didn't say that was ever on the cards. Looking at the data is the most important thing that you can ever do. The Fed raised its policy interest rate by 25 basis points. Chair Powell later went on to say that real GDP is rising at a below-trend pace of 0.9%, where the first quarter GDP was 1.1%. The housing sector is remaining weak, largely because of higher mortgage rates. This is also suppressing fixed investment by businesses because of higher rates in lending. The labor market remains tight. Over the first quarter, there were 345,000 jobs added per month. The unemployment rate is really low at 3.5%. What the Fed seeks to do by raising interest rates is to bring supply and demand back into balance with each other. And what caused this shock to supply and demand? It was the pandemic. This has already been a 3-year problem. Due to the pandemic, many people moved out of the workforce. The increase in the participation rate between 25 to 54 years is helping employment statistics. Nominal wage growth has shown some sign of easing. Job vacancies have declined, but overall the labor demand is still significantly exceeding the supply of available workers. He goes on to say that inflationary pressures continue to run very high and they've got a long way to go. Inflation erodes purchasing power. Over time, the purchasing power of each unit of currency is coming down because of inflation. This particular chart dates back all the way to 1910, just about when the Federal Reserve was founded. Look at this. They've not done a very good job of controlling inflation, have they? To combat inflation, which the Fed has never done, as you can see, by purchasing power, they've brought the federal funds rate into the target range of 5 to 5.25%. Something to keep your eye on. Jerome talks about policy tightening impacting the interest rate sensitive sectors of the economy, particularly housing and investment. He also says that it's going to take some time for the full effects of monetary restraint to be realized. With banks crashing right, left and center, of course, there's tighter credit conditions. A critical thing to note, Jerome says flatly, our future policy actions will depend on how events unfold. We will make that determination meeting by meeting. No, Jerome did not say we're going to pause interest rate hikes. But he said something else which is a little concerning. Jerome said, we are prepared to do more if greater monetary policy restraint is warranted. More what? More tightening, more increasing of the federal funds rate. How did the FOMC meeting minutes actually impact the market? We saw the VIX, the fear gauge of the market, coming down. But something interesting, we also saw the dollar coming down and yields coming down, bond prices going up. What does this mean? Recessionary worries. We could see oil was negatively affected as well. Again, recessionary worries. Does this mean we should panic? Absolutely not. A lot of people would become very, very bearish on this news. They would suggest that the markets are about to crash. Rule 252 is prepared and not scared. We have to have our three-dimensional thinking mapped out at all times. The risk indicator is getting close to rolling over, but it hasn't done so yet. How do you tell what potential direction the market is going? You need to look at a lot of charts. One of the best to look at is Bitcoin. Why is that? Because Bitcoin is one of the most risk-sensitive asset classes out there. What do we actually see when we look here? We can see the number of margin Bitcoin shorts is actually decreasing. The number of margin longs is slightly increasing. This actually signifies that the bearish side of the market is not acting that way. Another risk-sensitive measure is copper. After the FOMC meeting minutes came out, copper got smashed, but it came down to a smart money buy level. What do these smart money buy levels do? That's where smart money steps in to support or slow the descent of price. Copper is currently at 38995. And you can see it's just trying to get into that smart money sell area. We saw the Nasdaq sell down. It's currently 12,025. But what did we notice previously? It was coming up to a lot of smart money sell areas around the 12,270 mark. The S&P 500 is incredibly important to look at even if you're not in the stock market. We can see the S&P 500, which closed at 4090, couldn't get through. It was rejected multiple times by this 4157 to 4166 mark, and when it failed, it came down hard. One thing that we do note with the S&P 500, it doesn't have a lot of smart money support below it. It has smatterings, a little bit here and there, but a bulk of it is between 3882 to 3934. There is a bit of good news, however, and that is a however. A lot of people will think, get my money out of the banks. Well, that's probably not a bad idea. Putting and diversifying it off to different asset classes is probably not a bad thing to do. You could get into gold, you could get into crypto, you could get into bonds, you could get into so many things. But one thing that I want to show you, and I believe this is really important, a lot of people think the market will just crater. I actually don't believe that will happen. It could happen, but the markets don't work that way. When everybody thinks the markets are going a specific direction, it often surprises everybody and moves in the opposite one. Do we have anything to confirm that particular hypothesis? Yes, we do. We can see that the S&P 500 has overcome resistance. Does this mean it's beaten the resistance and hammered in a bottom? Perhaps, perhaps not. But we always do our three-dimensional thinking. We remain open to all three cases. What are these three cases? We know the price can go down, it can go flat, and it can go up. And we assess what we believe it can do on a daily basis. If you can't do it on a daily basis, you can definitely do it on a weekly one. The media is telling everybody, sell, 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 sell. But who is buying? If everybody is selling, there must be some deep-pocketed people who are buying. It's important that you always do your three-dimensional risk management. They say it's always darkest before the dawn, and what the Fed has been doing has making the world very, very dark, but it could be coming dawn very soon. So just keep your eye on this. One thing that if we look at Bitcoin's price history, we can see that NUPL, or net unrealized profit and loss, gets very, very red in the bear markets and then starts to recover. What are we actually seeing here? We're seeing a recovery. Another thing that is very, very important, Bitcoin cannot escape the stock market's gravity. If the stock market crashes, Bitcoin will crash as well. If the stock market crashes, gold will crash as well. I know a lot of people would be saying, Ken, you've got to be kidding. Gold doesn't crash. Gold just goes up and up and up. Gold is this gold line here. This is the COVID rundown, the US liquidity crisis. Notice what happened to gold. Did it just bypass all of this negative action? It did for a time, absolutely. But when people panic, they panic across all asset classes. This is something to put in your back pocket and remember. What about Bitcoin? What did Bitcoin do? It crashed down with the main markets and then it was the first to recover. What did oil do? As the markets were coming down, notice that oil was weakening before that actual case. But as the markets came down, oil came down, but it kept on going down as well. It actually turned negative. Can you imagine buying oil at 1 cent? You could have. Many people fear corrections in the market. Legendary investor Peter Lynch, who managed the Magellan Fund at Fidelity for 13 years, he says, don't worry about it. You can't do anything about it. The normal economic system is for the markets to go up and down. And that's just how the markets work. But if you are prepared when the markets come down, you could be buying oil at 1 cent. Or the S&P 500 at 2200. This is the time to get into the market, not the time to get out of the market. But you must have the knowledge and you must understand what you're doing. Personally, I'm so excited by these times. There's the opportunity for intergenerational wealth at these times in history, but only if you're prepared and not scared. Remembering Rule 4 is also very, very important. Price moves in waves. Even if the price is coming down, it will go up, and if the price is going up, it will come down. One thing to be aware of, the inflation rate is coming down. But look at the S&P 500, that's almost coiling to explode to the upside. What you will find in financial markets, you always have those three dimensions of price playing out simultaneously. You must get comfortable with uncertainty. One thing we also see, the federal funds rate has been going parabolic. What happens when it goes parabolic? We get this little bit of a kick down. But when it starts to curl over, that could actually signify problems. A lot of people think that as soon as the federal funds rate goes down, everything will be fine. Actually, that's the time when I would personally be concerned. Why is that? Because when the federal funds rate actually comes down, they're trying to stimulate the economic system because they've messed it up on the upside and they've messed it up on the downside. Basically, the Fed just messes things up. Your key as an active learner, look at as many charts as you possibly can. And Masterclass students, you get this live chart in LV29. As a global family, we solve every single problem with positive excellence. What does that mean? It means that we get the knowledge. We independently assess what is going on. We dig deep with our active learning. We contextualize information. We always use our three-dimensional thinking. We're not caught off guard by anything because we've already anticipated it. There is always a solution, and the solution is to get the knowledge first and foremost. Also, when looking at financial markets, don't look at them in terms of a normal citizen. Look at them in terms of institutional thinking. Don't trust in the institutions to protect you. Trust in your knowledge to protect you. Financial systems are very complex, but that doesn't mean that they can't be understood. When we see the unemployment rate starting to spike up, the Fed's funds rate starting to spike down, that is the sign that we need to pay attention. At the moment, we're not seeing those things in market. Another thing to keep your eye on, when you look at the federal funds rate and the 2-year yield, you can see that they've crossed each other just here. That's that position there. Going back to December of 2018, notice that the 2-year yield started to come down and the federal funds rate started to roll over. It's still, looking at the S&P 500, the S&P 500 was actually hammering upwards and onwards. Something just to bear in mind. A lot of people are getting increasingly bearish. It may not be the time to do so. One other factor that you might like to consider, credit spreads or the risk inside the banking system is starting to come down. Does that mean it's going to keep on coming down? We've seen so many banking failures. This could just be the start. But what we'll do is to keep our eye on that particular statistic. Always have your three-dimensional thinking playing out at all times. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again tomorrow. Bye for now.